Thank you for joining us
Uh,
today. My name's Rick. I'm with the Hendricks team and Keller Williams Realty. And today I'm speaking with Mr. Jim Binion, and he's with NEXA Mortgage. I'd like to introduce you to him and have him say a few words about himself and the company as well. Jim, go ahead and tell us a little bit about you.
hey Rick, how's it going?
Good.
Well, as you said, I'm Jim Binion. I'm with NEXA Mortgage. NEXA Mortgage is a mortgage broker. We work with about 245 different lenders. So we kind of handle every type of loan situation there is, from residential to commercial to land purchase, fix and flips, investment properties, you name it. Good credit, bad credit, medium credit. We pretty much handle everything. I've been in the business uh, for about 2 years now, and in early 2000s, I was in the business for 8 years. I'm also a licensed realtor, um, so I kind of know both sides of the business, and I think that can help during your purchase of a property.
Yeah, that's really good because you can understand both sides of the transaction a lot better.
Exactly. Yeah.
Yeah, yeah. Well, Jim, we're here to talk about the loan processing, just to answer a few questions that some people may have. So I have a few questions already lined up. Let me just start with talk about how does the loan approval process work and what documents will a client need to provide during the application process?
Right. So first thing that happens is when I talk to you as a potential buyer, um, I'll ask you some simple questions, about what do you think your credit score is, how long you've been at your job, are you a W-2 employee, or self-employed, just basic stuff, and kind of get a feel for where you're at, how much money do you have for down payment, things like that. Then once we talk and kind of get to know each other a little bit, I'll send you a application link. You'll go in and fill it out. Takes about 15 minutes, real easy to do. Once I have that, I put that in with your credit report and kind of calculate everything based off what you told me and based off of what your credit report says. Um, and then I'll give you a phone call. We'll have a conversation. I'll probably need a little more information. And then from there, I'll ask you to send me certain documents. Now, those documents typically are your last 2 years tax returns, your last 30 days pay stubs, if you have a 401k or some kind of retirement or life insurance, we'll get a statement for that. And then basically that's about it for now. You'll send those over. I'll put the correct numbers in the application and just make sure everything is accurate. And at that time, I would produce a pre-approval letter for you. And once you have that pre-approval letter, now it's time to go shop. Um, from that point, that's where Rick comes in. And then you guys go look at houses and everything. And once you have a purchase agreement, then Rick will send that to me. And then that's when the actual loan process starts. That's when we go to underwriting, we order the appraisal, title, all that. And then I'm with you the whole time to help you and kind of talk you off a ledge when you get freaked out a little bit. And and we usually take about 30 days to close, sometimes 20. I've had clear closes in 7 days. Some loans take a little longer. For the self-employed people, we might do a bank statement program or a profit and loss or 1099 program, and so those typically take a little bit longer than one does. But yeah, that's pretty much it in a nutshell, right there.
Well, that sounds great. That gives a lot of really good information. You had mentioned talking about down payment. In North Carolina,
Mhm.
we have a due diligence process and an earnest money process. Sometimes
Right,
that gets a little confusing with the down payment. So
right.
can you maybe elaborate on that a little bit?
So depending on the loan you do, uh, depends on how much down payment. Now, typically, let's say you're going to do a conventional loan, you have a credit score of 680 or above. Um, if you do not want to pay what's called PMI, and I'll explain that in a minute, then you're going to want to put 20% down, because the government insures loans up to 20. up to 80%. So when you when you put percent down, the lender carries a thing called property mortgage insurance, but you pay it, and it's actually to protect the lender, not you. It may not add much to your payment. It may add $50 a month, or it may add $75 a month, and then you pay that until the value of your property gets down enough, or the principal of your loan gets down enough to where you're below that 80% mark. But with that said, there are different options. We have a 1% down conventional loan, 3%, 5%, FHA's 3.5%, VA is 100% financing, USDA is 100% financing. And so there's options no matter what. And there's even options if you don't have down payment money, there's down payment assistance programs. Now, the way those work is you can go through the state and do it. And be honest, it's kind of tedious going through them. But most lenders now carry their own down payment assistance program. And it works two ways. You either qualify for a grant, and when you get the grant, it pays your down payment and you do not have to pay that money back. As long as you don't refinance it or sell it within 5 years. Every year they deduct a certain amount until you get to that point. The other way they do it is they'll carry a small second mortgage to cover that down payment. And that might add, $50 to your payment, but you don't have to come up with the down payment money. But very, very important to remember, down payment does not mean closing cost. There's a difference. Down payment is what you have to put down on the house. Closing costs is what all the fees and everything come to at closing. So you still have to come up with that money, or you have Rick get you seller concessions, which Rick can explain that.
Yeah, well, that's very interesting. So that's good to point out all that information. So in essence, really, when we have our due diligence and our earnest money, that's over and above what you're requesting for down payment, correct?
Yeah, that due diligence and earnest money comes off of the down payment. So, for example, let's say your total payment, just to play simple, was $3,500 for the down payment, but you have $1,000 down, combination of due diligence and earnest money. Well, now you only have to bring $2,500 to closing for that down payment. Does that make sense?
Yeah, that makes perfect
Yeah.
sense. That's a good way to explain it. All right, thank you for that. You've already touched on this too, but can you explain a little bit more about the different loan options like FHA, VA, conventional, USDA, just for a little
Yeah.
clarification?
There's a million of them. So, all right, let's see. Let's try to keep this as simple as possible. So, a conventional loan is people with credit scores of 680 or above. We can go below 680 sometimes. Um, that is your conventional Fannie Mae, Freddie Mac type loan. FHA is a government backed loan, Federal Housing Administration. Um, and that loan will go down to a 580 credit score,
Really?
uh, with 3.5% down. But here's what a lot of people don't know, and there's a lot of lenders that can't do this for various reasons, but you can actually do a FHA all the way down to a 500 credit score with 10% down.
Wow.
The catch on that is you cannot have any 30-day lates on your credit in the last year. So if you ran into a bad situation and for the last year you've been paying the bills on time and everything, and let's say your credit score is only 550 or 545, doesn't mean you can't get a loan. So I always tell people, if you got bad credit, call me and let's work it out. Even if you don't qualify now, I can tell you what you need to do to get your score where it needs to be at. VA loan. VA is obviously for veterans. That's all branches of the military, including the National Guard. Um, that is probably the best loan you can get because it's 100% financing. The rate is just as good, if not better than FHA or conventional. And the closing costs are super low on a VA loan too. USDA loan is a rural development type loan. So the home you pick has to be on the map in a certain area. That requires a 640 credit score. It is also 100% financing. But it is probably, I think it's probably the most difficult loan to do as far as there's a lot of restrictions on the appraisal, on the
Really?
type of property, things like that. Um, I mean, they all typically take about the same amount of time. I see a lot of people, well, don't do FHA or it takes forever. VA, it takes forever. It doesn't really. I've closed FHA and VAs just as fast as I do conventionals, if not faster.
Uh,
You know,
That's really great to know. Are there more stipulations with these other loans compared to conventional? Like, are there things that you have to watch out for?
not really. The biggest thing is the appraisal usually. With an FHA appraisal or a VA appraisal, they're going to be pickier. So I'll give you an example. A loan I'm doing right now. These people had some siding that was off their house from a hurricane we had a ways back, and it wasn't nothing major, but the appraiser noted that, and so we had to have that repaired before we could close the loan. And they're going to pick out things like rotted wood, um, anything that could be a safety hazard or safety issue. They'll do that, and typically the seller ends up fixing it. And then again, that's where Rick comes in at. But the nice thing about it is you're not going into a house that you're going to end up having problems with. But so basically, like the people that I was just talking about, they just fixed their sign this weekend. So now the appraiser will go out, he'll inspect it, he'll sign off of it, and then we'll close it on Friday. So it's USDA is about the same. They have, I mentioned they have some property restrictions. Like for FHA and VA and conventional, you can do regular stick built homes, you can do manufactured homes, you can even do single wides.
Okay.
With USDA, you can do a manufactured home, but it's got to be a brand new manufactured home, never been lived in.
Oh,
Where the other ones, they don't have that stipulation.
is there a time period for a manufactured home with the other ones? Like, I've heard maybe like 10 years. Within 10 years, it should have been built. Is that correct or no?
I'm not understanding that question.
Well, for example, if there's a manufactured home and it's an older one, you want
Mhm.
to get financing for it, but it was built back in 1976, we'll say. Is that too old for financing?
No, actually, 1976 the cutoff.
Ah,
So you can go back to 1976, and mind you, the advantage of being a broker is I have lenders that actually go back to 1965.
really?
It just won't be an FHA loan. It'll be a non-conforming loan, and
Yeah.
that's a loan that I did not mention. And the other loans out there besides what we've talked about is called non-conforming loans.
Mhm.
Um, we talk about bank statement programs, any self-employed type program is a non-conforming loan. Um, there's options for everybody. If you want to buy houses to fix them and flip them, that's that's obviously not a conventional loan, right? That's a short-term loan.
Right.
They'll per you'll they'll finance 80% of the purchase and 100% of the uh, rehab, and it's a short-term 1 year loan. So your idea of that loan is to get in, get the house, fix it up, sell it, make your money, and pay the bank off, and then walk away with your profit. So there's loans for everything out
That's great. Talk to me about one other thing too. Are there, besides an appraisal, are there any inspections that are required for any loans?
there. Yeah, like FHA and VA, they usually require a termite inspection. Sometimes they'll require a well and septic inspection, depending on the property. Um, that's pretty much about it there. I always think people should get a regular home inspection, which is different than an appraisal. A home inspector will come out and they will pick that house apart and they will note every little single thing wrong with it. And yeah, it costs you an extra 300 or 400 bucks to get done. But you have peace of mind and you know you're not coming into something that's going to end up costing you more money later.
Yeah.
So always recommend it, but it's not required by the lender.
Yeah, I highly recommend a home inspection, even if you're buying a brand new home, because sometimes home inspectors will find things that
Well,
builders have missed.
yeah, yeah.
So it's
See it
always
all the time.
that. Yeah. What about if somebody wants to build a new home?
Mhm.
Is there something like a bridge loan that's available?
Yeah, there's bridge loans. There's well, I always tell people we have lenders that do a one-time close construction loan. So basically, the typical construction loans, you go into a construction loan and the lender will give money as the construction process is going. And then at the end of that construction loan, you have to refinance it into a permanent long-term loan. But now a lot of lenders are saying, hey, why do that? Let's just do a one-time close. And that's really popular. And the nice thing about that is with the one-time closes, let's say you start your construction now and you're at 7% interest rate, but while your house is being built, the interest rates drop. You have the option at the end of the loan to take the lower interest rate,
Okay.
which is cool.
Yeah.
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 So, people say, well, I'm going to wait to build till before rates come down. You don't have to wait. You can just go ahead and start building. And then, when you're done, hopefully the rates are down.
Yeah. Yeah.
Yeah.
Speaking of rates, right now, what we know, the rates are right around 7, could be a little high, a little low.
Yeah.
Is this a good time to go ahead and finance and buy a house, even though the rates are at this 7% range?
Uh, well, I'm trying to think the best way to say this. The answer is yes. Because you're only dating the rate, you're not married. Okay. So if
That's
you you know what I mean?
yeah.
So if you're, let's say you say, well, I'm gonna wait till next year for the rates to go down. Okay, so let's say the rates go down to 5.5% by next year, right? Because your 2 and 3% rates they're gone. Okay, don't
Right.
wait on that. You wait forever.
Right.
Um, in that time you waited, that same house you wanted to buy is now 20, maybe 30% higher priced, depending on the market. So you might be saving a point and a half on interest rate, but you pay more for the house. So you're not really gaining anything. So the best thing is to go ahead and do it now, get in there. And then when the rates come down, just do a rate and term refi, which doesn't cost much to do. And then you can just lock into that and stay, and then you can marry that rate if you want.
Oh,
But
that's
you never marry before you date. So
true. So let me ask you, is there a time frame that they should wait? Let's say they go ahead and get a loan at 7% and the rates drop to 5.5.
mhm.
There are a certain time frame to wait before refinancing to that 5.5, we'll say.
Yeah, you want to wait a year.
Okay.
It well, it depends on the loan you do, but they used to say 6 months and one day. Um, and 6 months and one day is okay, but let's say you want to refinance, but instead of just doing a rate and term, you'd like to take some cash out because you really want to build that garage, or that extra building. You have to wait a year to do a cash out. Now you can do a rate and term in 6 months, 1 year though,
Okay.
or 6 months and one day. Yeah.
Yeah. All right. Well, that's great information. Let me see. Another question I have is, tell me about, you already touched on this, but tell me about fees associated with obtaining a mortgage. What are they?
So there's a lot of people don't realize how many hands are involved in doing a mortgage. Okay, so you have the originator, which would be me. You have a processor. You have an underwriter. you got closing department, you got doc prep department, you got a attorney for closing. There's so many things. Well, none of that stuff is free. So all these little charges add up and add up. The average closing cost, and it's hard to say the average closing cost because um, the closing cost depends on a few things. It depends on how much your taxes and insurance are going to be, because if you're going to escrow that, that's in your closing costs, and they're going to hold back 6 months or maybe 1 year, depending on the time of the year you do it. How much your attorney that you choose, how much do they charge for their services? So that's in your closing costs. The processing fee, which is usually around $800, $900. A lender fee is usually around $1,100. A broker fee, depending on the size of the loan, might be 2%, might be 1%, could be 2.5%. Just depends on who you're doing business with. What else is in there? And when I say attorney fees, it's not just the attorney fees. It's the title insurance. It's the wire transfer fee. It's the recording fee. Because the city and the cities that you're buying in, they charge for everything too. So there's a lot involved and a lot of people involved. But I would say the average closing costs, and I'm just throwing this out there, might be somewhere between $5,000 to $8,000. Okay, let's say on a $250,000, probably 5,000 to 8,000. But again, it's hard to say up front what it's going to be until you have all those numbers in front of you. And have you gotten a quote on your insurance yet? That makes a big deal, especially if you're here on the coast and they're killing you for hurricane insurance. That can make a big difference in your closing costs.
Yeah, that's true. That's true.
Yeah.
Well, I'll tell you what, let's go ahead and have a pause here. We'll make this a part one, and let's come back for a part two to talk a little bit further about
Okay.
interest rates. That sound good to you?
Sounds good to me.
All right. So stay tuned for part two of this question and answer regarding financing and how it can help you with your home purchase.